Let us understand the important changes in input tax credit reporting in Form GSTR 3B, which has been enabled on the GSTN portal from September 22 onwards. We will also cover practical illustrations of how to report in the new ITC reporting format. Let's take a quick preview of what would be covered here. If we look at the new format of ITC table, there are certain changes. Table 4 has 4 segments. 4A, the ITC availment part, 4B, the reversals, 4C, the most important one, the credit to the electronic credit ledger. What gets reflected in 4C is what gets credited to the electronic credit ledger. Then we have 4D, which is more a reporting table and will not have any impact on the electronic credit ledger. Now, let us understand the 8 important changes in ITC reporting. First, the basis of reporting ITC should be GSTR 2B compared with the books of accounts. All these while we were comparing books of accounts with 2B and then reporting, now it's reversed. Basis the data reflected in 2B, it has to be compared with books and then reported. Number 2, the ineligible ITC. Let's say a car is purchased which is not eligible for the ITC claim, that needs to be availed first and then reversed under permanent reversals under 4B1. Third, with respect to banks and financial institutions who can opt for a 50% flat reversal under Rule 38, they also need to report this 50% reversal in 4B1, which is a permanent reversal. Fourth, with respect to goods in transit, the earlier practice was we used to avail it only on receiving the goods. Now with the new reporting format where 2B becomes the basis, first it needs to be availed and reversed under temporary reversals in 4B2 and re-availed in the subsequent months on receipt of goods and reclaims to be reported in 4D1. The next important change with respect to creditors aging. Let's say a supplier is made payment after 180 days. Again, there were different practices which were being followed. With the new reporting, in the month of 2B reflection, it has to be availed, temporarily reversed under 4B2, reclaimed on payment made to the creditors, and then reclaim should be reported in 4D1. The next change, supplier credit notes. All this while, the supplier credit notes were reported under 4B2. There are instances where people used to reduce it from 4A5 itself and report as well. But the correct proposition would have been to reverse under 4B2. But now, given that the circular talks about classifying the reversals into two different categories, permanent reversals and temporary reversals, the credit notes needs to be reported in 4B1 wherever it is permanent in nature. Now, the 7th and the 8th change is that reporting of ineligible ITC. Let's say there are transactions like 16/4 time limit is over. Suppliers have uploaded March 21 invoice in August 22 after the time limit is over. So that gets auto-populated in the 2B segment, ITC not available. Similarly, there might be a Karnataka GSTN where accommodation services are availed in Delhi. So the Delhi will issue a CGST, SGST at Delhi. So that, owing to the place of supply restrictions, it's an ineligible ITC which is auto-populated in 2B again under the segment not available. Both these kinds of ineligible ITC needs to be reported in 4D2. Well, we are not talking about the legality or the principles, but we're entirely talking about how the auto-populated data in 2B needs to be reported owing to the changes brought in by notification 14/22 read along with circular 170. So these are the 8 important changes. Now, 5 important principles brought out in Circular 170. First and foremost, ineligible ITC should not get credited to electronic credit ledger. This principle, of course, section 16, 17, read with along with the rules, they certainly say only the eligible ITC should ultimately travel to the electronic credit ledger. That has been reiterated in this circular. That's the first principle. Second, whenever the reversal is permanent, that is, it is not a reclaimable credit, it needs to be reversed in 4B1. The words used in circular is such as, where it gives examples of where the permanent, what could be the permanent reversals. Similarly, wherever the reversals are temporary, that has to be reported in 4B2. Again, using the words such as, the circular gives certain examples. Fourth, in case of reclaims, that is, wherever the ITC was reversed temporarily under 4B2, whenever such credits are reclaimed, it has to be reported in 4D1. Although it will not have any impact on the electronic ledger, credit ledger, the idea appears to match 2B and 4B2 read along with this 4D1 to the total equation. The ultimate claim of credit should match 2B plus this temporary reversals. That should be the upper cap. That looks to be the whole idea. Hence, they've insisted on a reclaim to be reported in 4D1. Next, in case of the 16.4 time limit issues and also this place of supply related restricted credits, the circular again says it has to be reported in 4D2 and most importantly, it has to be excluded from 4A. The auto-populated to be already excludes this. Well, there are certain unresolved issues which the circular doesn't expressly cover. What are these? Let us say there are mismatches between portal data and books of accounts. There are transactions, the same supplier, same invoice number, same invoice date, everything, but values differ owing to some errors by the suppliers. How to go about with such instances? Similarly, there could be wrong uploads by the suppliers. Somebody else's transaction by a mistake of GST number might have got reflected in my GSTR 2B. How to go about in those scenarios, because in future those things will be amended or it may remain unamended as well. So how to address such instances? Next, transition issues. When I say transition issues, till August 22 we were following specific methodology for reporting. Come September 22 we are required to follow a new methodology. How do we address these transitions? Let's take an example. Goods in transit. The invoices were reported in previous 2B, but goods has reached now. Hence, there will be a gap between 2B and my claims. I neither availed it previously nor reversed. Now I am going to directly avail because I've become eligible. How to go about such transitional matters? Or previous transactions suppliers have amended in this month, which has got reflected in current 2B. How do we go about? So there is no express clarifications which has been provided yet. So in such instances, how do we go about? There are some possible approaches and solutions which has been discussed in this content for due consideration. Now, till now, if we could understand what was the 3B filed up to August was much, much simpler. Even in such simple 3B, people have committed errors to the various manners. Multiple kinds of errors have occurred. And imagine with so much complexity, the errors are only going to increase. Now, what might taxpayers resort to? Either owing to lack of awareness or otherwise, few people may prefer continuing the old 3B reporting format. Few people may keep 2B as basis and consider all sorts of reversals under temporary reversals in 4B2 because they want to come back, revisit and review whether it is reclaimable. And they might decide to do an annual reconciliation to finally segregate between permanent reversals and temporary reversals. Or Few may even consider going with the temporary reversals and all the segregations. They may consider doing it directly in GSTR 9, that is annual returns. All these approaches people may resort to. But there could be few who might want to go by the rule book verbatim and follow as prescribed. All the variances between 2B and the books of accounts has to be tracked till September of the following year, transaction by transaction, and multiple reporting at different places appropriately has to be done very, very diligently. Even though there is a honest intention to comply, inadvertent errors may still creep in. So how do we go about all of this? Let's stick to the principles as a practical approach probably. First, no ineligible credit should travel to the electronic credit ledger. Credit should travel only after fulfillment of credit claim conditions. In the enthusiasm of doing a detailed, elaborate compliance as prescribed, we must never miss out on claiming eligible credits. So ultimately, whatever reporting approach has been resorted to, what needs to be ensured is what travel to my electronic credit ledger annually, considering table 4C values, whether it matches with my eligible credits. That is the final equation to be checked, and by and large, if we can ensure this, probably we would be on a safer side. Well, whatever methods we decide and go about, certainly there are notices that would come in, be it in the form of scrutiny, be it in the form of audit or inspection. In case of transitional issues which we discussed, there will certainly going to be a gap between 2B and the 3B. Maintaining a list of transactions for which such claims have been made would help us be prepared to address these notices. Notices are going to come. We need to furnish explanations. We should first understand what are the proceedings which have been initiated, scrutiny, audit, inspection, or what else, and accordingly prepare ourselves and submit the suitable reply. Let's get into the detailed discussion about the changes along with the practical illustrations.
Let us see what all we are going to cover in this. Firstly, what's the change? The 8 important changes with a comparison of old versus new. We will understand why this change and what is the match equation we must not forget. The legal provisions facilitating these changes. We will certainly see the practical illustrations of few cases so that how we are required to report as per the new reporting format. There are also certain unresolved issues, and in such instances, what are the possible approaches we may take? Given the complexity of the new reporting, what may be the expected compliance levels by the taxpayers? This also we will be discussing. And the new reporting, which is more prone to errors, we will discuss what all the errors which can occur and how to rectify those errors subsequently. And not to forget the 4 important principles which with respect to this input tax credit reporting, which we must remember and do the compliances. Finally, we will also discuss the various implications and the preparedness which is required owing to these new changes. This is the new format of table 4 of the GSTR 3B, where 4B1 the reversal segment and 4D the reporting segment has been changed. Let us have a comparative view. Earlier, 4B1 stated reversals pertaining to Rule 42 and 43. This talks about the common credit reversals whenever the business has both taxable as well as exempted turnover, both with respect to input services as well as capital goods. Now, with the new change, Rule 38 and Section 17.5 have been added to 4B1. Rule 38 is the financial institutions and banks which can opt for a flat 50% ITC reversal option. That is what is required to be reported here. 17.5 talks about certain blocked credits, purchase of a motor car, a food bill or a restaurant bill, such other items which are blocked for input tax credits. Those also have been added to this reversal segment under 4B1. Now there is this 4D, which is the reporting segment, where it talks about reclaiming ITC out of the reversals under 4B2. I will be discussing all of this in more detail in the coming slides. For time being, let's understand that the reporting requirement has also undergone change. Earlier 17.5 was required to be reported here, which is the blocked credits. But with the new reporting format, only the reclaims out of 4B2 are to be reported. And 4D2 shall include the ineligible ITC, that is 16.4 timeline, where the supplier uploads after the September of the following year, or ITC restricted due to place of supply provisions. A Karnataka GSTN availing accommodation services at Delhi, where the CGST, SGST of Delhi would become ineligible to Karnataka GSTN. So this is the broad change in the reporting format per se when we compare the old Form 3B versus new Form 3B. Let us first understand this table 4, which is segmented into four broad categories. Now, this we have to remember throughout this presentation, so that I will be making references to these 4 segments with these headers. 4A is about availment of ITC. 4B is about reversals of ITC. 4C is the most critical part because this is what travels to my electronic credit ledger. 4D is only a reporting requirement where there will be no impact on the electronic credit ledger. So I repeat, 4A talks about availment, 4B about reversals, 4C is what hits the electronic credit ledger, 4D is only a reporting table. Now further, 4A has 5 segments. We all are aware and used to it, but just for a quick glance, we have 5 segments under 4A: import of goods, import of services, other RCM than these two above, then input service distributor related credits, and finally 4A5 we have all other ITC. Now with the new reporting format in 4B, the permanent reversals which we are not going to reclaim should be reported in 4B1, and the temporary reversals which we are going to reclaim in future, we have to report that in 4B2. As I iterated in the beginning, what is most important amongst all these segments is table 4C, because that is what travels to my electronic credit ledger, and that is what would be the eligible ITC. The very header of the table 4 talks about eligible ITC, then that is what it means. So 4C should consist only eligible ITC. Now 4D, as per the new reporting format, although it will not have any impact on my electronic credit ledger, there is a reporting requirement where whatever temporarily I reversed, out of that, whatever reclaims I make, that should get reported in 4D1, and certain ineligible ITC, the one we discussed earlier, 16.4 related and the place of supply related restricted ITC, those things to be reported in 4D2 directly without being part in 4A. Let us understand this 8 important changes in ITC reporting come this September 2022. The first one, the basis of reporting in table 4A. Till now, we kept books of accounts as the basis for reporting ITC. Of course, we compared with 2B, and in case there are any mismatch transactions or the suppliers have not uploaded, then we used to follow up, and then once it is reported in 2B, we used to claim it. But as per the new reporting, the basis becomes GSTR 2B compared with books of accounts. Earlier it was books of accounts compared with 2B. Now 2B itself becomes the basis for reporting, which in turn has to be compared with our books of accounts. The second important change, reporting of ineligible or blocked credits. I gave few examples which is listed here as well. Earlier, such ineligible ITC were neither availed nor reversed but directly reported in 4D1. I'm sure many would have adopted their own methodology of reporting earlier, but by and large, what has been seen is that it is neither availed nor reversed but directly reported in 4D1. But what is the new change? First, this has to be availed in 4A owing to the auto population in 2B, then permanently reverse in 4B1. The next example or the change which is there is this banking and financial institutions who can opt for a 50% flat reversal under Rule 38. Earlier, they used to avail all the credits in 4A and reverse in 4B2, but now they will have to permanently reverse in 4B1. Supplier credit notes. Earlier, the reversals used to happen in 4B2. Now, again, there are two possible perspectives to think through this, but principally what they have brought out in Circular 170, which I'll be covering in detail in the coming slides. Principally, they have segmented permanent reversals under 4B1 and temporary reversals under 4B2. The supplier credit notes are generally permanent in nature, and owing to that reason, based on that principle, probably going forward, we have to permanently reverse in table 4B1 itself. The fifth important change is with respect to reavailment of ITC. Rule 37 I'm talking here. Let us say I made the payment to my creditors after 180 days. Earlier what we used to do was, we used to reverse in table 4B2 if it was availed at the very first instance. That is, I availed the ITC, I could not make the payment within 180 days. So I reversed that in 4B2 and again reavail in table 4A. However, with the new reporting format, irrespective of what principles I followed earlier, now what am I required to do is avail in 4A, reverse in 4B2 because it's going to be a temporary reversal. Once I make the payment to my creditor in future, I will reavail in 4A and report the reclaim in 4D1. So this is the parameter change in the reporting per se. Similarly, with respect to credits pertaining to goods not yet received, certain credits were deferred and reavailed later. Like, I'm not sure whether I'm eligible for that, whether conditions have been fulfilled or not. Whenever such transactions existed, probably businesses were analyzing them and then taking a call of availing. This was the past practice. But now, based on 2B, if it is reflecting, they have to temporarily reverse in 4B2, and once they fulfill the conditions like the goods have been received now, then they will reavail in 4A and report in 4D1. Now, 7 and 8 covers the ineligible ITC owing to 16.4, where the supplier has uploaded the GSTR1 after September of the subsequent year. So 16.4 time limit is over. I'm presuming taxes are also paid afterwards. And of course, there can be a legal debate about these provisions. I'm not touching that now. But presuming the taxes also haven't been paid in time and it is decided to be an ineligible credit. This and the another example which I took where accommodation services obtained in Delhi by a Karnataka GSTN, both these were mostly unreported in the previous reporting format. However, the new reporting requires it to be directly reported in table 4D2. Why the word direct reporting is used? Because it has to be excluded from 4A. If we examine the auto-populated 2B, then it already excludes that from 4A and reports directly in 4D2. So we will take a practical example of this as well. I've taken a sample GSTR 2B where you have this ITC available segment, ITC not available, the B2B transactions, B2B amendments, B2B credit notes, B2B credit note amendments, ISD inputs, ISD amendments, import of goods and import of goods from SEZ units. So these are the segments which are there in the GSTR 2B. In this sample, I have sum total all the B2B transactions which is coming to this value highlighted in yellow. ITC not available owing to place of supply restrictions is what is highlighted in red. Now what gets auto-populated to the ITC available part which gets reported in system generated 4A is what is highlighted in green. Let us see this. So my sum total is what is highlighted in yellow. If we look at ITC not available tab, there is something which gets auto-populated here, and if we arrive at the values in ITC available, that excludes this ITC not available. Now let us see what is the reason which the system gives for ITC not available. So we have a reason column here. Let us say we want to see only which is system has identified as ITC is not available. In this instance, all the reasons why ITC is not available is owing to this place of supply differences between the example which I took, the Delhi accommodation services being availed by Karnataka GSTN. So that is the reason over here. And if we examine this auto-populated system generated 3B, there again this all other ITC excludes the ineligible ITC identified by the system, which now needs to be directly reported here in this ineligible ITC others 4D2, and that should not form part of this 4A file. This practical example is shown to understand this principle, what the new reporting talks about. Let us continue with the presentation. Why this change? We have seen that government has been determined to ensure the ITC matching process. A lot of changes and automation has been brought in. So the idea probably is to track the gap between GSTR 3B and the 2B part. We may also correlate to section 16 to AA, an additional condition which has been inserted for the purpose of claiming the input tax credits, which talks about reflection in GSTR 2B is a condition for the ITC claim. And also this matching, once it is implemented upon and complied, it will facilitate data analysis for the scrutiny of returns. Probably these are the objectives with which this change has been brought in. Now what is that we should remember as the match equation? Table 4A should be less than or equal to GSTR 2B plus the cumulative temporary reversals which we effect in 4B2. If we remember this equation, I think by and large we are through with the new reporting process. So what does this new reporting process insist upon then? Principally match 4A with 2B. The only exception is the ineligible ITC owing to 16.4 and the POS which we just saw, that has to be excluded from 4A and directly report in 4D2. And permanent or unreclaimable reversals to be reported in 4B1. Temporary reversals where we would be claiming in future to be reversed in 4B2. Reclaims, apart from being claimed through 4A, it has to be reported in 4D1, the reporting segment. And 4D1, the reclaim should be less than or equal to 4B2 cumulatively. Hence, the ultimate formula is that GSTR 2B plus 4B2 cumulatively should match my 4C, which is the claims which go to the electronic credit ledger. Let me just give a simple thing. It might look like a very complicated formula which has been put in, but step by step we understand, then we will arrive at it. The logic is what travels to the electronic credit ledger through the table 4C, which is the critical element of this table 4, that should be less than or equal to GSTR 2B plus cumulative 4B2. This is the whole idea. Discussing on all these things, it might sound very complicated, but if we understand it logically step by step, I'm sure we will be able to arrive at what is the match equation. Ultimately, if we try and compile the whole information, let's say on a financial year basis, my whole of table 4A should be less than or equal to GSTR 2B plus the cumulative temporary reversals, that is under 4B2. If this is ensured, I'm sure we can all rest assured that what has traveled to my electronic credit ledger through 4C is only the eligible credit. So this formula is critical here. So I'm just covering quickly the legal provisions of how this could be substantiated. Section 109 of the Finance Act 2021, which got notified with effect from 1st January 22, has inserted a new section 16(2)AA, which is a condition, additional condition to claim the input tax credit. Now what this says is, whatever claims are made, such invoices or debit notes should be furnished by the supplier in GSTR 1, which should be communicated to the recipient in GSTR 2B. This is the condition. I'm also extracted the amendment in the Karnataka GST Act, where the similar provision has been inserted as well as notified. These are all the screenshots of the respective sections just for the reference, along with the notification which has given effect to this from first day of January 2022. One more important change in the rule with respect to GSTR 1 is that, again, this is effective from 1st January 22, which says unless you file the previous GSTR 3B, it could be monthly for monthly filers and quarterly for quarterly filers. Unless you have filed the previous 3B, you can't file the next GSTR 1. So all this goes to support the principle which the government is looking at for ITC matching. Now comes the new form which we discussed till now. The legal provisions is covered in Rule 11 of the Central Goods and Service Tax Amendment Rules 2022. In fact, this has been notified with effect from 18th July itself. However, it has been implemented on portal on 1st of September 22. The reference notification is 14/22. Now, GSTN advisory dated 22nd July, it stated that although this notification is there, portal is still in the process of implementing. So till such implementation, please follow the old method. However, legal sanctity to be given to this advisory through either a clarification through circular or amendment in the corresponding provisions per se, or the rule implementation date per se. Now on 2nd September, another advisory came up which said that from 1st September, these changes have been implemented in the portal and new reporting format is ready to go live. There is also an important circular which talks about the various scenarios and how to report in the new reporting format, which is the circular 170. The purpose the circular talks about is that to ensure uniformity in the return filing. It has been issued under section 168 subsection 1. Now the gist of the circular is that till now the government has observed that different practices are followed to report the reversals and ineligible ITC. Principally, the circular we'll talk about the principles which the circular highlights. Principally, what travels to my electronic credit ledger should not contain any ineligible credits, and the non-reclaimable or the absolute or the permanent reversals, whatever name we call it, it has used the words such as, probably to give more from an example perspective. Whatever is permanently reversible has to be reversed through 4B1. Reclaimable or the temporary ITC reversals has to be executed through 4B2. And inadvertent claims of previous periods, it may be reported in 4B2. So to understand the gist of this circular, probably we have to keep the principles in mind that only eligible credits to travel to electronic credit ledger, permanent reversals to be reported in 4B1, temporary reversals to be reported in 4B2. I think if we understand principally these things, we are good to go. Based on these principles, we can classify the reversals into two categories. So in 4B1, that is the permanent reversals, we will be doing 50% in case of banks and financial institutions. The common credit reversals, again, there is an issue if at all the common credit reversals, when we recalculate at the year end and there is a reclaim at that point in time, putting it under 4B1 may fix us under trouble. So we may have to take a call regarding this. I'm explaining an illustration in the coming slides. Similarly, the ineligible ITC, the 17.5 blocked credits, in the rule we call it as the T3 credits, that also needs to be reported in this 4B1. Other ineligible credits, let's say it is used for non-business purpose or purely exempt transactions, that is the T1 and T2 credits, this also needs to be reversed under 4B1. The supplier credit notes, which are more permanent in nature, but if we look at August GSTR 2B, which has auto-populated data, there again the credit notes are getting reported in 4B2 itself. But if we principally understand this circular, what is trying to do and what is the whole purpose of this new reporting, that is to match my claims with 2B coupled with cumulative 4B2. So if that equation has to be matched, then we have to categorically do the reversals wherever it is permanent in nature in 4B1 and temporary in nature in 4B2. So the non-payment to suppliers within 180 days, it would be a temporary reversal. Non-receipt of goods or services, that would also be a temporary reversal. Non-payment of taxes for the time being. So all these could be under temporary reversals. Now we discussed 4D is only a reporting table where we will be segmenting it under two categories. And reclaims would come in 4D1 while the ineligible would come in 4D2. Let us see some practical illustrations of how we would go about with this. Now, I have taken just very few transactions so that we will understand principally of how the new reporting works. If we look at the 2B, this is the GSTR 2B, which is auto-populated in August 22. There are 5 transactions in it. If we examine the ITC register as per books, we have 4 transactions in this. The first 2 transactions match between the 2B and books. The third transaction, it matches, but it is ineligible under 17.5. Let's say it's a food bill or a restaurant invoice. So that is ineligible under 17.5. Now, if we look at the one highlighted in blue, one is 16.4 time limit is over. Let's say March 21 invoice is reflected in August 22 2B. So 16.4 time limit is over. And another one is goods not yet received. Supplier, it's a goods in transit. Like supplier has uploaded and sent the goods. I am yet to receive the goods. So that does my total 2B for the August month has 5 transactions totaling up my IGST values to 40,000. In the books, I have one transaction which supplier has not uploaded. My total books value ITC is only 31,000, out of which 4,000 my supplier has not uploaded. Now let us see how do we report this in the new reporting format. Now the total 2B value is 40,000, but there is this 7,000 where time limit under 16.4 is over. So like we discussed in the previous example, presuming it is not available, it's an ITC which is ineligible, then that has to be reduced from 4A5. So 40,000 minus 7,000, 33,000 is what will come to my 4A5, and the 7,000 will directly go as reporting over here in 4D2. Now coming to this 8,000 which has matched but ineligible under 17.5. This will be a permanent reversal, so I will report it in 4B1. Now coming to this 6,000 which is goods not yet received, it is a temporary reversal because in future once goods are received I will reclaim it, hence I will report in 4B2. During September, once I received these goods, it will be part of the previous 2B itself. So what I'll do is I will reclaim it under 6,000. Whatever I reclaimed I will report in 4D1. Now imagine there are only 5 transactions which are picked up in 2B, and when there are multiple transactions, keeping track of all these variances between 2B and books, and that too till September of the next year, would be really a humongous and a Herculean task. And in the enthusiasm of going to report all of these things in detail, we must not end up making more mistakes. So we just covered how the new reporting practically works. Let us now look into unresolved issues. Now, broadly, whatever has been covered in circular, we took as exam practical illustrations, trying to understand that. But there are so many practical scenarios which are not covered. Let us say there is a mismatch between portal and books of accounts. Now, 2 examples we will take. Now, what is this mismatch description? Value doesn't match, but supplier GSTN, invoice number, invoice date, everything else match. If we look at here, value doesn't match, but all other details match. Now, let us further examine that what does the supplier do? He will realize the mistake in the next month and he will rectify the original entry itself through amendment in the next month return. What is the example here? As per portal, value is reflected as 6,000 in month 1, but my books show 5,500 which is based on the actual transaction. Now, the supplier has made this amendment of 5,500 in month 2. What is the possible approach we may adopt for the reporting? In month 1, we will avail 6,000 and reverse the entire thing under temporary reversals, because next month when he makes the amendment, we should be able to give effect to that. So month 1, I will avail 6,000 in 4A, reverse in temporary reversals in 4B to 6,000. Month 2, I will reclaim this 6,000 in 4A5 and report 6,000 in 4D1. However, my net ITC which should go to electronic credit ledger is 5,500. But since the 2B will automatically reduce this 500 when traveling to table 4A, I have to reclaim the entire thing. This is how we are going to think about owing to the auto population. Probably going by the rule book, it would be sufficient to avail only 5,500, which would be more a right approach. But because there is an auto population and there is a reverse method of reporting which is insisted, I think we will have to end up doing the reporting this way. Let us check practically a scenario. Now this is another month 2B where invoices have been amended. My B2B amendment section has certain transactions, and owing to these amendments, there is a downward amendment. So earlier what was uploaded was high, and the sum total effect of all the amendments is coming as a negative value. Now if we see here, we have this amendment related negative values which is adjusted and reduced in the table 4A. Now let us see the system generated 3B. So if we look at the system generated 3B, it has taken after reducing that amendment, downward amendment which has happened. So thereby this is what has to be practically done. Let us take another example where what is uploaded in the portal is less, but as per my books, it is more. So 6,500 is uploaded in portal, while in my books, it is 7,500. Amendment made as 7,500 in month 2. So in month 1, again I will avail as per 2B and reverse because it is an erroneous value. In month 2, I will reclaim 6,500 and report it in 4D1. Owing to upward amendment, 1000 will automatically get added to 4A5. Like we saw in the example previously, it is a negative value, but here we will have a positive value. Let us take the next example of unresolved issue where wrong uploads by the supplier. The example considered transactions where other GSTN related data is uploaded to our GSTN by mistakes due to distinct persons, that is same PAN multi-GSTN issue, or GSTN of a sister entity is concerned, or owing to some other inadvertent error, this might have happened. So what is the possible approach we may adopt? Avail 5,000 in 4A, reverse in 4B2, because on rectification in the next month or whenever the supplier does, we have to reclaim this and again report in 4D1. Why we have to reclaim and report? Because owing to the change in GST number by the supplier, that will get automatically reduced from our 2B in the corresponding month. Like the example which I have shared here, once there is a values are, the GST number is changed, the B2B invoice amendment will show negative values, and what gets carried to my 4A is after the reduction of this negative values. So that is probably the methodology we may have to follow. Now, what is the mode of amendment or rectification by the supplier in these instances? Two possibilities. He may amend by altering the original entry. He may upload a credit note to wrong GSTN and fresh invoice to right GSTN. We all understand credit notes can be issued only for the 4 scenarios envisaged under section 34, but practically we see that for all sorts of error rectification, credit notes are being used. Now, in the old reporting scenario, if it was not my transaction, then I neither used to avail it nor used to reverse it. I used to ignore both these documents, invoices as well as credit notes. But because of the new methodology where it is insisted to keep 2B itself as the basis, we end up availing it and reversing it. Again, the similar approach what we discussed in the previous examples we have to adopt. The difference when original entry is altered is that, like we discussed, it will have a downward amendment, that is the negative values will come, leaving the reduced values in 4A. Alternatively, if it comes as credit notes, then it will go directly to 4B2. Again, we'll have to take a call. Probably we will reverse in 4B1 because of it being the permanent reversal. We also have a couple of other issues with respect to transition. In the sense, transition from old 3B reporting which we followed till August and new 3B format which we will follow from September onwards. Now let's say goods was received in the current month, but the invoice has already been uploaded in the 2B of the past month. We were following the old method of neither claiming nor reversing and directly claiming only on goods being received. Similarly, there might have been some amendments. Supplier has uploaded previously a CGST, SGST, now he has changed to IGST, or he has rectified some values which were incorrect. I did not take any action in the previous month because I was waiting for the supplier to correct all of that, and once correct transactions get reflected in my 2B, I was availing it. Now, how do I handle this come this new reporting? I would suggest probably we will make a list of all such transactions where in case of this migration and transition process, we will make those lists and claim those so that tomorrow when questions are asked, we will be in a position to explain what are the differential claims which is not matching our equation of 4A less than or equal to 2B plus 4B2. So this equation matching difference, we have a separate working which we can explain through. The another scenario which I've taken up is the Rule 42 reversals. Now, Rule 42 talks about this common credit reversal. That is, whenever my business has both taxable as well as exempt transaction, I need to do this common credit reversals on a month-on-month basis. And at the year end, I will have to recompute these values, arriving at the whole year turnover, what is my total taxable turnover for the entire year and the total exempt turnover for the entire year. I've taken a scenario where month on month I have been reversing 1,20,000 totally, but on recomputing the actual values turned out to be lesser, that is 1 lakh rupees. Now, how do I go about with this scenario? Because the form says Rule 42-43 reversals has to be reported in 4B1, which is more of a permanent reversal in nature. Now, plausible approaches we may adopt. Since I don't know what is my final reversal which is going to come across, probably I may resort to reporting it in 4B2 itself on a month-on-month basis, reclaim the entire amount of 1,20,000 in March in 4A, report in 4D1, and then reverse 1 lakh, which is my actual reversal, in 4B1. So this will probably give a exact picture of for the whole year, how much is my the common credit reversal, which ultimately I arrived at. Alternatively, we may consider doing the entire reversals in the March return itself. However, interest might apply because Rule 42 Subrule 2 Clause A says that the interest is applicable with respect to common credit reversal with effect from 1st April of the subsequent year till the date of payment. Ideally, this should have been due date of March month rather than 1st of April, but since given that scenario, probably for 20 days we might end up paying interest. We may have to take a call. Ideally, we may go with the first approach to avoid the interest repercussions. Taking the next scenario, IGST paid on import of goods not reflected in 2B. We have seen that although IceGate integration has happened, all the transactions from IceGate is not flowing to a 3B returns. Ultimately, the claim condition says tax should have been paid, and bill of entry is the tax paid proof document basis which we may go ahead and claim the credit. Probably we'll raise a grievance saying that all the transactions of import of goods has not reflected in 2B. So, but the underlying document would be the bill of entries basis which we will probably go and claim the credits. Now, practically there are so many challenges and complications in doing all of this reporting what we discussed now. To understand itself, there are 4 segments. Each thing has to go into a specific segment, and this has to be kept track till September of the following year. All these challenges are there. Now, what can be the expected compliance from the taxpayers? Practically, people may resort to different methodologies as may be convenient to them or whatsoever. Few people might continue the old 3P reporting format, given that either they are not aware of these changes, they did not keenly observe what new form has brought in, or they don't have enough resources or time to do all of that. People may resort to do the old reporting itself. Some people may resort to do all reversals in 4B2, irrespective of whether it is temporary or permanent, and whatever is eligible they may reclaim, and ultimately at the year end they may analyze and put the permanent reversals in 4B1 in the March return. Also, there is a possibility that such reporting is directly taken care in GSTR 9. Put everything under 4B1 and ultimately analyze the reversals in form GSTR 9 directly. So, although the procedure is so very cumbersome and complicated, people may resort to simpler ways of reporting in their own methodologies. All this means that in the simple existing form 3B itself, we have practically seen so many varieties of errors occur. And given that the new reporting format will pitch in, it will certainly lead to more errors. It could be like we end up claiming less credits or excess credits are claimed interchange between permanent and temporary reversals, non-reporting of reclaims, non-reporting of ineligible credits, all these errors might occur. Let us not forget the 4 important principles to follow. First and foremost thing, we should never miss claiming the eligible credits in the enthusiasm of this detailed reporting. This is very critical. Secondly, whenever in case of any doubt, it is better to report under temporary reversals so that later on we may review and report appropriately in the subsequent period. And most importantly, like brought out principally in the Circular 170 also, one must ensure ineligible ITC should not travel to the electronic credit ledger. This is what section 16, with the corresponding rules also talk about. Only eligible credits, even the form table 4 has the heading eligible ITC. What we should ensure is only eligible ITC travels to the electronic credit ledger. And the ITC should travel only after fulfillment of claim conditions. If 4 principles what we discussed now is ensured, I think by and large we would be good to go. Now rectification of ITC errors, like we discussed in the previous slides, more elaborate reporting, more prone to errors, then how do we rectify this? Unclaimed or less claimed credits, like we do a yearly reconciliation either during March month or during September month. We ensure what finally reached electronic credit ledger will match the final eligible ITC as per my books of accounts compared with 2B. If at all there is any less claim or unclaimed credits, please ensure it is claimed within September of the following year. Suppose, owing to all this elaborate reporting, we have by mistake claimed excess credit and such ITC is availed but not utilized, then it has to be reversed without interest. Alternatively, if it is availed and utilized, then it has to be reversed with interest at 18%. The new rate for ITC reversal after utilization is 18%. This has already come into force and it has to be computed in accordance with Rule 88B, which has been notified again with effect from 18th June. Of course, it is a retrospective amendment. But yes, we will follow the principles laid out in this Rule 88B for the computation. Now, what is the mode of reversal? Reversed within September of the subsequent year, then it will be through GSTR 3B. After that, it will be through DRC 03. We should ensure we consolidate all of this and report appropriately in GSTR 9 and 9C so that all rectifications are reported appropriately. In case of any questions during the departmental intervention or examination, it will assist in explanation of what has happened factually. Now, given this reporting and what the various practices and measures or the methodologies what taxpayers may adopt or practically what may happen, ultimately what are the implications? We already see so many ASMT 10 or the system driven scrutiny notices where 1 and 3B are compared, GSTR 3B and 2A are compared and all of this. This is going to increase in the days to come given that the new reporting format insists about comparing 2B with 3B and report the ITC appropriately. We also have the system generated 3B for comparison. The case could be picked up under audit. Under section 65, ADT 1 might be issued in case they find it's a fit case and there is huge differences between the reporting style, what is that. Also inspection could be taken up. Let us understand that it is not possible to avoid departmental intervention. We have to set our mind to attend to the notices and reply appropriately. It is not possible to avoid. Let us try our best in doing the compliance as required, ensuring the 4 principles we discussed in the previous slide, so that the match equation of table 4A less than or equal to 2B plus cumulative 4B2 will reduce the chances of departmental intervention. Given that, despite that, if we should be prepared to face it, let us have the appropriate workings like explained previously, especially in case of transition, that is Till August, I followed an old reporting system. From September, I'm going to follow new reporting system. What are the differential reporting, the underlying line item wise transactions, if workings, we keep it now. That will help us. And principally, we have to ensure only eligible ITC ultimately get credited to the electronic credit ledger. And most importantly, we should also ensure that we should never be silent on notices, be it ASMT 10, ADT 1, or INS 1. We should understand what is the notice, what under which provisions they have been initiated, what should be the corresponding reply to it, and then take a call to reply suitably. Hope this helps in understanding the new format of GSTR 3B. In case of any questions, please feel to write back to us at askgst.as@gmail.com. Thank you very much.